Good.
There's just plenty of people around.
Let us get going. And I'd like to say hello and welcome to everyone who's joined us today in the first of what we hope will be a series of calls, of webinars entitled Bitcoin and Gold in 2022. Just a couple of points of order before we start. The first is to say none of what you hear today is investment advice, and it should not be construed as such. This is just a bit of light entertainment in the spirit of general enlightenment that comes at a fascinating time in world economics. Secondly, for those who want to ask questions, there is a Q&A button. Please tap in your questions. I can't promise that we'll answer them all, but we'll try and feed in relevant ones as the conversation goes on. And there's also a chat facility for anyone who wants to exchange thoughts or ideas as we go through. And lastly, a recording of this will be made available and will be on YouTube over the next couple of days, I hope. So on with the call, we are, Charlie Morris and I are utterly delighted on behalf of ByteTree and ByteTree Asset Management to have Russell Napier with us today, the eminent financial historian and author. He's, as you know, he's filled in last minute for Chris Wood, and in football terms, it's analogous to Ronaldo going off with an injury and pulling Lionel Messi off the bench. We couldn't be more honoured, and his thoughts and writings over a 30-year period have been utterly invaluable to investors worldwide. I certainly remember him from my Asian days. One of very few people who understood properly what was going on in the Asian financial crisis, when most of us, myself particularly, were reasonably clueless about the mess that was unfurling in front of our eyes. Russell's latest book is entitled The Asian Financial Crisis, and as we enter a period where debt levels globally are off the charts and inflation is raising its ugly head, I think it would be the best thing would be to start at the beginning and ask you, Russell, about the Asian financial crisis and how it formed at the start of what many would call the sort of a debt super cycle, and how it's unfurled over the years.
Sure, thanks, Charlie. Delighted to be here. And let me say why the start is important for the end, because most people are not interested in history. So the reason that the start is, and we're now at the end, is that the Asian financial crisis set up a form of monetary system which has conditioned the return from financial assets for 25 years. If that monetary system was to continue, then who cares? But it isn't. It's changing. So I think to fully understand the implications for asset prices, we have to understand the beginning, the scale of the distortions, because those distortions are likely to be unwound. So the beginning was the devaluation of these Asian exchange rates. But really importantly, that they weren't then allowed to respond on the upside. By 1998, the market had cleared. I mean, let's be clear what clearing meant. If you held Indonesian equities, you'd lost over 90% in dollar terms. So that's a pretty vicious form of clearing, but it was a form of clearing. In most countries that were in real distress, the IMF had come in and put down some pretty strong markers as to how these mainly democratically elected governments would have to implement policy. So they conformed largely, not entirely, but largely conformed with that. But in return, they did not let these exchange rates go back up. Now, most of them had not suffered high levels of inflation during the crisis. Indonesia was really the exception. So because they hadn't had the inflation, but they'd had the devaluations, they were incredibly competitive. And they joined in 1998 another country which was already very competitive, which was China in 1994. So now we have established what Paul Volcker used to call the hybrid system. The Bretton Woods system was an agreed system of who would peg to who at what rates, surrounded by capital controls. This was never agreed. This was a unilateral decision by certain Asian countries that this was the level of the exchange rate and this is where it would stay. And that was implemented against the background of the free movement of capital, which has other implications. But anyway, how did this create the debt super cycle and how did this bring it to an end? They exported deflation. Many of the prices of goods coming from places like Korea and China are the same price today as they were in 1997. And the beneficiaries of that have clearly been the importers, such as the United States or Europe. So that helps to put downward pressure on interest rates, the fact that you're importing deflation. Central bankers, as we know, decided the most destructive and terrible and awful thing that could ever happen to them was deflation. So the fact that it was being imported they didn't seem to care. Arguably, that was a good form of deflation. But anyway, they just said, no, all deflation is bad, therefore we will fight it. So that kept their short-term rates low. And then, of course, the next bit is that to manipulate your exchange rate and hold it down, you end up buying huge amounts of other people's fixed interest securities, particularly the government securities and particularly treasuries. So we're now holding down the long end as well. So I would argue this hybrid system partially decoupled the discount rate and the growth rate. And that is the most bullish scenario you can possibly have for taking on more debt. And right at the end of this crisis, we had this little episode called LTCM. Now I've forgotten the history to many people. But without going into the details, Alan Greenspan reduced interest rates, changed the monetary policy of the reserve currency because a speculative financial institution was going bankrupt. And it was a huge signal to anybody and everybody that if you speculate long enough and hard enough, the central bank will change monetary policies to support your speculation. Now, that's a heady brew. We didn't have to have the last bit, frankly, but we got it anyway. You put that heady brew together and you watch global non-financial debt to GDP ratios go from roughly 200% to 300%. And that's enough to get us into a situation where the debt level is so high, it is creating a system that is so unstable and so dangerous that now debts have to be inflated away. And then we have to talk about, have they managed to put in place a system that can do that? And what does that system look like? And what does that mean for return on assets? But it will be entirely different from the system we've lived in for the last 25 years. And that's why I think the start of this actually is so important for all of us, because most of us just live through business cycles. But living through the change in a whole monetary system is something different. And I would say it's not that different to what happened from around 1968. Bretton Woods doesn't end for 3 years. But what should you have done in 68 to protect and defend the purchasing power of your wealth? Well, something radically different than you would have done in any of the previous business cycles since the end of World War II. And I think that's where we are. So a new monetary system is coming. The old one was distortionary. We can then discuss what the unwinding of those distortions means for returns from various assets.
Absolutely. I suppose one of the questions that always strikes me is how has it been able to last so long, this system, without unwinding? I mean, here we are 20 plus years later, and it's only just come to a head.
The answer to that has to be, for those who were undervaluing their exchange rates, there are clearly obvious benefits to that. Obvious benefits for competitiveness, obvious benefits for growth. So you can see why they would want to continue it. They were the ones setting the artificial prices. So, they set the only reason for setting an artificial price is because you benefit from it. So that half of the equation is fairly straightforward. The more difficult half of the equation is, why did everybody else put up with it? And in that, you have to include every big economy with a floating exchange rate. So that would include Japan, the European Union, obviously America, and basically all the other members of the G7. Why on earth did they put up with it? because for certain sections of society, it was also highly beneficial. It was certainly highly beneficial for anybody who owned assets and for anybody who geared over those assets. Most, not all, but large businesses tended to benefit from this and expressed an opinion to government that this should continue because they tended to benefit from it. And those who were losing out from this tended to be, I wouldn't call them the voiceless because we live in a democracy, but tended to be not as, their voices were not as powerful outside of election season as the voices of other interest groups in society who do have power outside of election season. So the inequalities that it built up were accepted. The imbalances of debt were accepted. Remember that Modigliani and Miller, I think, bear a lot of responsibility for this. There was this sort of belief that debt levels didn't really matter. And I think that permeated more generally in policymakers. Remember, we had a central bank governor in America who said that his job was not to stop parties, but to clear up hangovers. So there was a general, and remember, Greenspan famously went before Congress after the 2007 crisis and said he was amazed at how the enlightened self-interest of certain participants in the system hadn't created a stable system. Well, the people inside the system weren't amazed by that because the incentives were put in place that were so distortionary that people seized on the incentives. So I've named about 5 or 6 guilty parties there, but the guilty parties were clearly in the people who accepted these policies being implemented in terms of undervaluing exchange rates. It begs the question, really, if we'd been a policymaker in 1998, what we'd have done about it. I mean, how much leverage did you have to bring to bear to say to primarily Asia, you must not peg your currencies, you must let them adjust freely, you mustn't run external surpluses, you mustn't buy all our treasuries. It needed a lot of political capital to do it. And in my book, Charlie, I flag up an interesting speech by Bill Clinton in October 1998, pointing out some of the downsides that we've just been discussing, the long-term downsides. But frankly, there wasn't the political capital to go toe-to-toe with China, with the rest of Asia. I mean, America had gone toe-to-toe with Japan in an attempt to change its financial system in the 1980s and really hadn't got very far. Japan was ultimately crippled by its own monetary mistakes, or arguably monetary mistakes forced upon it in the late 1980s. So the political capital was not there. And we just kind of live with it. And I think many of us thought after the 2007-2009 crisis that something would be done about it. But frankly, they tried to put it, well, in my opinion, what would be a Band-Aid. Quantitative easing was effectively a Band-Aid to try and hold together an existing system. Probably not great surprise. That's what you do first. But I think they've come to a revolution now. This is no rebellion. This is a revolution that none of this works and we're going to change all of it. And so now we have the monetary revolution. That old system is to blame. Let's fix it. Whether they coherently can string all that together and really understand it, I'm not 100% sure, but they can see the consequences of it and the consequences of it at the ballot box, importantly, as well as in the financial system, and now seem prepared to do something about it.
So, Russell, you've kind of been on record as a deflationist all the way through to last year, and then you think something changed last March 2020 when big stimulus package in response to COVID. That was your trigger point, and I guess we're here to talk about the outlook for asset prices, particularly gold and Bitcoin. But I guess it's important to touch on everything to try and understand why those are things that are interesting to us, at least. And by the way, quite amusingly, you're not a Bitcoin bull on record, so we'll get to that as well. But so can you talk about the inflation that lies ahead and why?
Yeah, so what happened was not stimulus in the traditional sense of the word, not fiscal stimulus. Had it been fiscal stimulus, I really probably wouldn't have changed my mind. But what did happen was an explosion in bank lending. And I have never witnessed an explosion in bank lending in a recession. I have witnessed explosion in bank lending in a huge economic boom with asset price bubbles, but never in a recession. And if I go through economic history, I can't find any booms in bank credit during a recession. If I go back over the last 20 years, I can't find bank credit growth anywhere near as high as it's been in the last 18 months, anytime in the last 20 years. That's the factor that changed. That's the one thing that changed everything for me. Now, why on earth would banks lend more money into recession, given that they have never in history lent money into recession? And the answer is because the government guaranteed the risk and said, you will not lose money on these loans. So suddenly there's no downside in expanding credit. Now, I believe that's the new normal. Now, this is where I get a lot of pushback. People say to me, well, yeah, so this was COVID, it was an emergency, they offered those guarantees, and of course, bank credit growth expands, but they'll pull them out. They'll stop that now. That's something that's the past. That was an emergency measure and it will end. The reason why this is so important is, unlike fiscal policy, it creates money. That's how most of the money in the economy is created. To go to the Bank of England website, there's a lovely little article on how money is made and how over 80% of all the money in the world is made by commercial banks and not central banks. So you either believe that our governments have taken a level of control through carrots and sticks of the commercial banking system, and with that now can create as much money as they like, or you don't. Now, I'm clearly in the camp that believes this is a permanent change in how money is made. And what it means is central bankers are impotent. They're completely and utterly impotent. I mean, they can talk all they like about nudging short rates up by 20 basis points or 50 basis points or 100 basis points. They can talk all they like about reducing the size of the reserves in the system through contracting their balance sheets. But if the government ultimately sets the growth rate of bank credit, they are impotent. And I don't even pause to say it. I think it's so obvious, but yet it can't be that obvious. Otherwise, why are people wasting man hours of their lives, women hours of their lives, person hours of their lives discussing the central bankers when every word they utter means it's kind of irrelevant? I mean, if I look at the growth rate currently in commercial bank credit in America, which is going to be money supply growth in America, it's running well into double digits. Do we really think that 25 basis points on short is going to make any difference? I mean, it's kind of living like Alice in Wonderland. So, Charlie, that's what I mean by revolution. To me, that's the revolution. Somebody else is controlling the supply of money, and very few people seem to have bothered to notice, potentially because all our skill set is analysing the Fed. So let's just keep analysing them, even though they're impotent, because that's what we know how to do. Or let's recognise that this is a new world, and asset prices will behave incredibly different in that world. And it's, in my opinion, a world not unlike 1945 to 1978, and potentially we can draw some parallels from that to help us. So that's why I changed my mind, and I see no reason to change it back. In fact, when I look at what's happening in Europe and everywhere else, these guarantees are absolutely here to stay. The next emergency is obvious after COVID. It's the saving the planet emergency, and bank credit guarantees will have to be used for that. So we're in the perma emergency. I'm sure you've both seen that Mr. Draghi and Mr. Macron saying that we have to defeat this mad German fetish about not having constant stimulus. So the revolution is behind us. It's not in front of us, but it's, I think, fairly bizarre that the world is still focused on Jerome Powell, as if Jerome Powell actually matters.
Well, I guess, is he trying to sort of create the narrative that there's a sort of tightening cycle ahead? But to your point, really, there's absolutely no evidence that that's the case.
Yeah, there's a nice little parallel for that. It's the final scene in The Wizard of Oz. I don't know if you can remember it. That turns out that the wizard is just a little man behind an organ. He doesn't actually have any real power, but he makes very loud pronouncements on a regular basis. And at some stage, those loud pronouncements can work until the days people realize that there are no connections between the tools of monetary policy and the outcomes of monetary policy. I mean, monetary policy is a supply of money. It's not the price of money. And he might theoretically be able to control the price of money, but he doesn't. He needs to control the supply of money. But he sits in front of Congress, whatever it was, 2.5 weeks ago, and says, oh, there's no point in controlling the supply of money because it's entirely irrelevant. So, Jerome Powell is doing what any of us would do at this stage. It's Jean-Claude Juncker, his famous quote, when things are tough, when things get really bad, you have to lie. And I don't have any doubt, I have no doubt whatsoever that's what he's doing. He realizes he's lost control of this, but that's the last card. That is the last card in the pack. So you have to play it, and you have to do it with great, you have to do it very vociferously. You have to do it with complete commitment. It's like being an officer in the army having to take a hill that you can't take. You still have to convince 30 guys in the platoon to go with you. So here we go.
Yeah. And talking about disconnects, of course, one thing we've picked up is this big disconnect between growth rates and discount rates, which you've talked about. What are the sort of implications of that?
Yeah, so that's the most important thing of what I don't think we've named it yet, but it is financial repression, and it is just so profound because I didn't study economics. You can probably tell that. But if you study economics, they tell you that there is a link between the growth rate and the discount rate, because the growth rate is inherent and laden with inflation. That's part of the growth. There's real, and then there's the other bit, and you get your nominal. And the two have to be linked, because what sort of fixed interest security investor would not seek compensation for future inflation? So therefore, the two are linked. And everybody who studies economics is taught that. But of course, it's completely untrue, because there have been long periods in history where it simply wasn't true. But that's because we didn't live in a market economy. In a market economy, those things are true. But you can suspend the forces of a market economy. And that's why I mentioned in particular, it was really from 1939 to 1978, we just suspended those forces, and we severed the link. And you sever the link by taking the element of choice out of the ownership of fixed interest securities and bringing in an element of compulsion and compelling savers to own assets that they wouldn't own with yields that they wouldn't own. And then, of course, that link is severed. Now, there's so many unbelievably interesting consequences from that. One of them might be that equities are worth infinity. If the growth rate, and we say that nominal growth rate has some impact on corporate earnings growth, stays consistently way above the discount rate, your net present value calculation is going to be pretty big. So infinity is the wrong word, but a very, very high level. So there's obviously good reasons. Maybe we'll come back to why that can't be true. But suddenly, nearly everything you've learned in economics is wrong if you sever the link between the growth rate and the discount rate. And to do it, it involves a huge amount of administrative action and administrative controls. So you basically get a bull market in the word control and a bear market in the word market. And, go back to the Wizard of Oz. We're not in Kansas anymore.
Yeah, absolutely. So we've got to a point, and I think this is what everyone is on tenterhooks about, where you've identified inflation as being something that's here to stay, but a huge amount of commentary, and actually I've seen something today from the big investment banks commenting on gold, which is still ploughing the path that inflation is transitory. It's COVID, supply chain shocks, but growth will be back. We'll all be back to normal next year. I'm fascinated to hear why you think, or if you think that it's got longer legs. But one of the things I think people hide behind is they say, well, there hasn't been any wage inflation yet. We're not really seeing evidence of that, which to me might be a kind of a lagging indicator rather than a leading indicator. Is it going to get worse? What happens over the next 2 to 3 years?
Yeah, I used to define central bankers as people who enjoy inflation in everything except wages. That would be but I think I have to stop that now, because Jerome Powell often talks about the need for higher wages. In fact, he even talks about the need for higher wages amongst minorities. And, whatever we think of those as social goals, they're not really the job of the central banker. So, let's be clear that even central bankers are changing their opinions on the need for higher wages. The outlook for inflation, I start with money and work backwards, which is desperately unfashionable. And certainly Jerome Powell doesn't do that sort of analysis. But my call last year was that inflation would be above 4%. And for the OECD average, and it would get there before the end of 2021. And that's proved to be correct. But it was based on some fairly back of a fag packet calculations, which simply said broad money growth is above 10. Have we ever had a period in history where you had broad money growth above 10 and didn't have inflation above 4? And I know someone's now going to send you an email, Charlie, saying, yeah, well, in Caracas in 1943. So I'm sure there are possibly places where it did happen, but it just doesn't really happen that way. And of course, Jerome Powell will absolutely refute that there's any connection between those two things, but there is that connection. But also, I think it helps us look through the supply side constraints, and there are clearly supply side constraints that are driving inflation in the short run. And none of us can really get a good grip on those, and they will pass. I've got enough faith in markets to know that supply will adjust. The number of LNG tankers steaming from Louisiana towards Europe is a good sign of how these things work themselves out.
Yeah.
But if we say that broad money growth stabilizes above 10, then I don't have a problem saying that inflation stabilizes above 4. So that's where we are looking at. And then we throw in the second complication, which is velocity. Now, I know we've only got an hour in total. We could spend an hour talking about velocity. There is a risk that at some stage you lose control of velocity. And I would define that as the time when everybody on this call decides that they need to have something in their savings portfolio, which was previously something they only considered to be something, a consumption good. So, I mean, the classic examples, and this is where we get to Turkey, would be the automobile. So Turks have been doing many things to try and preserve their wealth at a time of a collapsing lira, but buying automobiles has been one of them. And I witnessed that in Indonesia in 1998. Now, I don't think, this is my view, in the next 3 years, I don't think we will see velocity change that much. I don't think we will be in a stage where everybody on this call will take some of their savings and have, 3 cars sitting outside. But it's possible. And therefore, if it becomes possible, that's when you're talking about inflation, getting closer to 10 or above. And I think Turkey's tells us some interesting things about that. I don't think velocity really takes off in Turkey until inflation's closer to 10 or above. So my bet would be that velocity wouldn't go up in the next 3 years, that the supply side generally sorts itself out. But inflation still settles down between 4 and 6. And crucially, interest rates don't go up. I mean, that's the most important forecast. It's not actually about inflation. It's about a permanent severing of that link between inflation and the discount rate. And that's, in terms of managing a portfolio and selecting assets, that's the key change that you have to get. Not the level of inflation, the breaking that link between inflation and discount rate.
Charlie, you're on mute. You're still on mute.
This. Sorry about that. So Russell, your thesis is very much you have phase 1 and phase 2 of financial repression. And financial repression, which you've just described, for those who aren't quite sure, it basically means interest rates are a long way below the level of inflation. And in the good old days, you put your money in the bank and you got an interest rate that was higher than inflation. And so children would save, and that would be very nice. And from a bank deposit, nowadays it's the other way around. You get poor by putting your money in the bank. So that's bad. So alternative assets come into their own, as you just described. It could be a car. I think in the Second World War, there was a tendency to buy a grand piano. Is that right? Or was that around the time of the German hyperinflation? So anything that's real, that's still going to be real after that, whilst money fades. So can you explain the difference between, phase 1, financial repression, which we kind of has been going on for some time, and what happens when we go into phase 2?
We are in phase 1, and that's obviously very beneficial for asset prices. The dangerous bit for phase 2 is when we begin to lose control of long-term interest rates. That is theoretically a market, and there is some vestige of a market left in the determination of long-term rates. And if they start to get out of control, and if they start to rise dramatically, then we have to go to plan B. Now, most people watching this will think, well, plan B is really easy. The central bank just buys more long-term government bonds, but actually that cannot be the response. And the thing that's changed is this. In stage A of a financial repression, the central bank's balance sheet expands, bank reserves are created, inflation goes up, but the market doesn't really believe it. And then one morning you wake up and it does believe it. Then the central bank has to stop extending its balance sheet, because otherwise, in a world of rising inflation, and we believe in future inflation, the central bank's running an entirely pro-cyclical policy, which is keep short rates down, keep long rates down, keep expanding the balance sheet. I mean, it's the road to absolute ruin, and they're not stupid. They know that. At the minute, they're in phase 1 because they're not having that massive reaction at the long end yet. So when that reaction comes, then you have to stop, but you have to stop expanding the central bank balance sheet. But you still have to keep long rates down. So in my opinion, Charlie, stage 2 is when you then go to the savings institutions and say, look, the bond yield can't go above 2, and you're buying them all at 2. Full stop. So this is different, because when the central bank buys the bonds, it creates reserves. When the life insurance companies of the world create bonds, no money is created at all. There is no direct effect on the money supply. I mean, there's a direct impact on interest rates, but not on the money supply. And this is, okay, so we've still got the wrong monetary policy because the price of money along the yield curve is wrong, but at least we're not printing lots of money or creating lots of bank reserves when we do it. Now, the reason that stage 2 is so important is that in stage 1, you buy equities. I was kind of only facetiously saying that when the growth rate goes up and the discount rate doesn't, equities go to infinity. That's what we're witnessing. The Q ratio for the US market is at a level never recorded before. But when we get to the stage where you have to force savings institutions to buy government bonds, you're forcing them to sell something. And they can sell anything, but in that portfolio, that means they're going to start selling equities. So suddenly, repression has a forced seller of equities, even though the fundamentals were telling you to be a forced buyer of equities. It's kind of because the fundamentals are telling you to be a forced buyer of equities that actually you're a compelled buyer of bonds, because no one in their right mind is going to want to own a bond. So you have to force them to own a bond, and then you force them to own an equity. So that's an interesting dynamic, because I'm sure everybody watching this can close their eyes and see the chart of the cyclically adjusted PE back to 1881. And there are different types of bear markets in that. There are kind of the really short, sharp shock ones like 29 to 32, 2007, 2009. They're all associated with collapses in earnings. But the really interesting ones are the ones that are associated with a boom in corporate earnings, which would be 1901 to 1921 and 1966 to 1982. Corporate earnings go up, but the stock market over that very long period of time comes down. And I think that's more like the bear market we're going to have. So there are a lot of people who think, it's just going to explode and it's just going to collapse. And of course that could be correct. But it seems to be more likely that we're going to get this long, slow, forced liquidation. In a financial repression, we haven't discussed it yet. There would be re-equitization. Maybe we can discuss why. But forcing a re-equitization of highly leveraged balance sheets by the corporate at a time when you force the savings institutions to sell equities is definitely a recipe for lower equity valuations. So that's the trigger for phase two. And that's why I think phase two is so important, because you go from being a bull of equities to a bear from equities when you can see that we're going from stage one to stage two. Equities cannot be worth infinity, but the only reason they're not worth infinity is because we have forced sellers.
In practical terms, though, how do you actually force institutions to do that?
Well, it's already happening. So, what's fascinating so my main job is to speak to institutional investors. And I have clients right along the spectrum. I used to call it the investment spectrum, but now I think I have to call it the regulatory spectrum. So at one end, I have life insurance companies generally. They don't ask me that question, Charlie, because they've been subjected to this for years. Asset liability modeling, et cetera, forces them to hold. And legally, they're forced to own these government bonds that they know are bad investments. And they get upset when I talk about financial repression. They said to me, it's ridiculous that you're forecasting this when we've lived with it for 12 years. Now, at the other end of the regulatory spectrum, I have clients who are hedge funds. And they say, we'll never have financial repression. Can't happen. This is a free country. It would never happen. So it's bizarre because we've got two people basically in the same industry at different ends of the regulatory thing. So basically what you have to do is slide this regulation along the continuum and just keep moving it up and up until you encapsulate way beyond life insurance companies. Look at the German insurance companies. I've been saying it for years. I think everybody knows it, but nobody can publicly say it, that many of these companies are bust. There is no conceivable way that they can pay up on many legacy policies they wrote offering 3.5%. And everybody knows it, but we just pretend it isn't happening. So I think it's already happening. It's just a matter of spreading it out the regulatory spectrum. It is a form of capital control, of course, as well. If I say to you that 50% of all your assets have to be in British government bonds, that is a form of capital control. I'm restricting your ability to own overseas assets, not in the old form of capital control that we had from 45 to 79 in this country, but it's a form of capital control. So that's how you do it. And I like to kind of steal a little bit from Mrs. Beaton and say, if you want to shoot fish in a barrel, first put your fish in a barrel. And that's what capital controls are. But just, I know Charlie's got a question, but just one, I keep getting this old people say, but look, this is impossible. You can't do this in a modern world. It's actually easier than it's ever been. If we go back to the end of World War II, to the extent that financial assets were owned by the household sector, they were in their own names. I think the figure is 65% of the equity market was owned by individuals. And now I think at best, the British is 11, 12%. It was quite hard to regulate and repress an individual, not impossible, but quite difficult. But when it's all owned by regulated financial institutions, it's the easiest thing in the world to repress and force them to do something. It's maybe ironical that we just got rid of the compulsory purchase of annuities. But the compulsory purchase of annuities is a classic policy of repression, which forces elderly savers to buy bonds that are just a shockingly bad investment. So I don't have any doubt that they know how to do it, nor that it's started, which is important. But it just has to move up that continuum.
But that's the point, isn't it? Because we've got the example with ESG funds and how BlackRock, for example, Larry Fink of BlackRock is willingly moving trillions of dollars to a mandate that the client didn't ask for. And that's another example, isn't it?
Sure, I never voted for Larry Fink, so I don't know why Larry Fink's morals now determine the allocation of global capital. I mean, I didn't vote for him. I don't know who did vote for him, but he's now more powerful than just about any elected politician.
Of course, he's got the money. But I mean, to bring it back to gold, so gold likes low real interest rates, which you've alluded to, and you're going to keep the bond yield down because through some of these mechanisms you described. But more importantly, there's no choice but for the cost of borrowing to stay low because there's so much debt in the world. And on the other side of it, you've explained why you think, driven by the banking system, not so much the money supply, but the bank lending increase, that's pretty structural because the banks have been underwritten by the governments. And so that's a perfect environment for a hard asset, isn't it? And that's why gold is pretty strong in your eyes.
Yeah, so just simply say yes to that bit and then add in the second bit. To keep these bond yields low in this environment involves huge amounts of regulation. I mean, if I go back to the last one, it wasn't just that you forced savings institutions to buy this stuff. You had to screw up returns on other assets as well to make this stuff attractive. So you had to put in particularly high taxes on dividends, for instance. We had dividend controls as well. There were rent controls to make property less attractive. There were high transaction taxes on equities, but no transaction taxes on bonds. So you're really, really interfering with returns and assets. Now, gold was the one that's just less easy to do that. In fact, it's now become so irrelevant that you wouldn't even bother. If we go back to the famous Roosevelt Edict of 1933 on the confiscation of gold, that was important then because gold was an important asset and money was gold and gold was money. And it was widely held by the population, and not to abuse that part of the savings system would be to avoid abusing a large part of the savings system. But now it's tiny compared to the size of financial assets and the wealth in financial assets. So it may be the time might come when they start looking at gold, but frankly, it is so small relative to all this. This is politicians here. You take the low-hanging fruit. And gold is difficult because it's more difficult to find. It's often held by individuals. It's too small, and you might get there in the end. But just take all this other money first because it's so much easier to do. So it is the story of negative real rates, Charlie. But there's something else there as well, which is in terms of interfering with the ability on where you can put your money. Gold is kind of at the bottom, is at the top of the tree, too difficult to get. Maybe they'll get there one day, but it's really not necessary to go after gold when there's so much easy money that you can take off people. I mean, if you just look at Greece, Cyprus, and Iceland, which are the three developed world countries that had to implement exchange controls, they never bothered to go after gold because it was so easy to go after everything else. At least maybe they did go after. I'm not aware that they went after gold. It was just so easy to go after the rest of it. Why bother chasing this tiny amount of gold? So that gives it another value, and it does move freely across borders. So anybody who's looking for a nice read in the new year should read "Travels with My Aunt" by Graham Greene. And I'm not going to spoil the story, but he's a beautiful author anyway. It's not a long novel, and read it, and it explains. I'm giving too much away. But anyway, things that move freely cross-border, whether legally or illegally, suddenly attract a very large premium.
Which is a very neat moment to move on to the digital world. So, our friend Satoshi Nakamoto designed Bitcoin around the idea of gold, what you described, limited supply, but with the benefit of transportability and so forth. What are your views on that? And do you think it's part of the financial repression protection strategy?
So I think it's ultimately the problem is it's too good. So this is the problem. So there are two threats to government. from crypto generally. One is it becomes a means of transaction. Now that's a huge threat to them. And you remember the Libra affair when Zuckerberg announced he was launching a currency called Libra. And like within weeks, he had to back down from that because the governments could see that that would genuinely be a means of transaction and that Zuckerberg would control the means of transaction, and they stopped it. So, that's not where crypto is at the minute, as far as I'm concerned. So as long as it doesn't trespass into that, it can keep going. But if it starts to trespass into that, then we get into deep regulatory issues. The governments have already done it with Libra. They closed it down within weeks. So that's the first thing. In terms of moving that money cross-border, which is the other thing that it offers, then that's also not today, tomorrow, maybe even next year, but it does become a major threat to governments if this is a form of wealth that can move seamlessly cross-border. Because I've been writing since 2007 that the end game of this, when we finally get to a new monetary system, will be capital controls. Capital controls have holes and they have leaks. People exploit those holes and those leaks. So you'll be playing, for anybody who's in that business, whether it's using crypto or gold or anything else, you'll be playing a game of cat and mouse with the government. But ultimately, the problem with crypto is it's just too successful at doing this that I think they'll ultimately have to do something about it. But I don't know when that will be necessary. But I think the Libra episode is really, because that was many years ago. And it was really interesting how quickly they had to act when it looked like it would take that power away from them. And if they decided to stop the free movement of capital, then that's something would have to be done about that particular hole and other holes in the system that they see. So that's my concerns about it. It's not that it isn't going to be successful. It's going to be too threatening, and something that I often think about. This is a libertarians love Bitcoin. The private sector controls the supply of money, but I cannot think of when libertarians have been successful. At least since the death of Wyatt Earp. Could we say that?
I think with the case of Facebook and the Libra project. They've now changed. The first thing they did was change the name. It's now DM. I think it's going to come back and just look like stable coins, which no doubt.
But Charlie, that's really important because they brought it back as a stable coin, and that's fine. I don't think there's any problem with the stable coin. So as Libra, they created a currency. As DM, it's a stable coin, and that's going to be fine.
Yeah, sure. But I think it's hilarious that your skepticism on cryptos is too good. Because it absolutely slides across that border without anyone really noticing, and that is hilarious. But I suppose that the other point you've been making in your writings is about asset allocation. And it's all well and good to have some gold and whatever else, grand piano and secondhand cars outside. But actually, you talk about radical weightings, not just radical assets. So actually having some useful asset, but having a decent exposure to it. Can you expand on that?
Yeah. So, I think it's worthwhile going back in periods in history. So the one I like to start is the late 60s. Why? Because the monetary system broke down in 71. So if I'm right, and we're going through a breakdown in monetary history, what is the lesson from the last time that the sort of monetary system broke down? So as I'm sure everybody here knows, you lost a lot of money in bonds and equities. So you lost in nominal terms, and my goodness, you lost in real terms. So what was the optimum portfolio to have in 1968 to preserve wealth? Well, it may have been as simple as gold and Swiss francs, or maybe Swiss franc government bonds. That was it. Now, those two assets weren't actually that risky. Gold was pegged to the dollar at the time, as you know, so there was little chance that the gold price would go down. It wasn't clear that it would go up because Bretton Woods had to end for it to go up, but there was little chance that it would go down. So I don't think anybody would have considered it to be a particularly risky asset to own. And Swiss franc government bonds no one considered those risky. Those were always considered to be low risk. That was a very unindebted government because it didn't participate in World War II. So they weren't risky assets, but you had to hold them in a risky size. So if I'd been sitting in 68 and gone to the boss running a multi-asset portfolio, gone to the guy who was CEO of the listed fund management company and said, I'm putting 40% of all the portfolios into Swiss government bonds and gold, he just would have thought I was insane. But actually, it was the weighting that was risky, not, in his eyes, based on the previous monetary system. The weighting was risky, but the assets weren't. So I think it's a risky weighting. So I have a few, but not many, that would be in that. Gold is definitely one of them, as you know. I actually think value stocks, particularly maybe Japanese equities and the value in Japanese equities, there are some countries that probably don't have to put in place a financial repression, and they should be okay, and those are selected emerging markets. But these are, if you had an asset class weighting now, these would be 10% of all assets, 15% of all assets. And I'm suggesting you build an entire portfolio around 50% of the assets available. And people consider that to be hugely risky, even though they don't consider any of the particular assets. I don't think anybody considers any of those assets to be particularly risky. So that's what I mean about having a risky weighting when you move from one monetary system to another monetary system, as we have now already done, in my opinion.
So basically your portfolio that you're proposing, which is owning these niche assets and selling the mainstream, it's sort of short career risk and long common sense, which there's nothing wrong with that, is there? And I'd be totally behind that.
Yeah,
this Jeremy Grantham 7-year, the forecast, the GMO forecast of asset returns. The only thing it's looking forward to is basically value or emerging markets, and you'd probably knock out China, wouldn't you? Because you'd think that would be a repression of a stage 2 country. Yeah. So the sort of EM X China, hard assets, gold. We can debate Bitcoin that's too good for our portfolio, whether it should be in or not, and just countries, cash in countries that are okay, that are not part of this. Indonesia would be one, wouldn't it? Mexico might be another.
Yep. I don't know. I mean, I haven't written about Indonesia, but certainly I think, Mexico, but I certainly think Indonesia. My focus for historical reasons has more been Asia, but I think, India is another pretty good example. So and I love the introduction to that, Charlie. But this career risk thing is really important. Really important. I don't know if you have retail investors watching this, but you must not underestimate the inability of fund managers to make these decisions. I mean, I summed them up earlier, I think, with the 1968 example. It is almost impossible for an institutional manager to make the decisions with your money that he might or she might be making with their own money. And that's just the nature of the beast. And I think everybody has to understand it. One of the seminal books on investing is called One Up in Wall Street, when Peter Lynch explains why you as an individual don't have the conflicts or the career risk that a professional might have. And that has never been more true than it is today. Some of the world's greatest investors are now under huge pressure because the returns have been so poor for several years now, because they own the wrong sort of stocks. So, I think everybody watching this has to, I write a lot about the difference between principals and agents. And there are some fund managers who behave like principals, and they have the freedom to behave like principals. But you know what? Nearly all of them own the company. And that's the difference. And if we look at people like Sir John Templeton and why they were able to make these alarming, what seemed at the time alarming decisions, like buying lots of Japanese equities at a time when Japan had capital controls. Sir John owned the company, so he could behave like a principal. And that's where you need to be looking if you're looking for somebody who's managing money, someone who can behave like a principal. And that they're almost impossible to find in large institutions, particularly listed fund management institutions, where the incentives are so radically different from what I think you might want as an end consumer of the product.
And one of the things, to put some meat on that, if you're one of these fund managers that's been dying in recent years, it's probably because you didn't own the FANGs. And in order to shut down your career risk, you've got to go and buy the FANGs at record prices. And this is the mad behavior that happens in asset price bubbles. We saw it in the late 1990s. I certainly remember working in a firm where I mentioned where Vodafone was 15% of the UK index, and there was a sort of the risk department going around checking everyone had enough Vodafone in their portfolios. It was an extraordinary thing. £2 next stock 40p per share, and so this is not always a good idea just because of quarterly deviation from the pack. But could you just before we move on to some of the good points that some of the listeners have made, just sort of remind us the difference between a proper old-fashioned company with a productive output versus a modern financialized company with a great financial output.
Yeah, in terms of listed stocks, I've just written a huge piece on this, 40 pages, so I'm not going to be able to summarize it. But the old monetary system facilitated financial engineering. And there should be a link. Keynes wrote about it, Tobin wrote about it. To plug my course, we talk about it a lot in my course. There should be a link between the market valuation of assets and the cost of constructing them. So that if the market valuation of assets gets too high, 2 times replacement cost, the whole world should start producing those assets and listing them on the stock market. And that's the bit that didn't seem to work. There was too much financial capital around. It allowed financial engineering, but ultimately it should have brought a massive creation of assets onto the marketplace. And it didn't do it. And the reason, in my opinion, it didn't do it is because of those undervaluation exchange rates. Because it was incredibly difficult to build a steel plant or a chemical plant or an automobile plant, or kind of the tangible assets that one would have historically associated with this mechanism. You couldn't build them because they were so cheap and producing at undervaluations somewhere else. And I use past tense for that, and I think past tense is the right way to do it. So the market obviously bid up these other things that were kind of light on assets. You didn't have to value them relative to assets. There's no point in valuing Facebook relative to its assets. And therefore, it's difficult to value, in my opinion. Intangibles are always more difficult to value. And the market played that game. And there was ample amount of financial capital to play that game. And private equity obviously was enfranchised to play the game as well. But the bit that was broken is we didn't create these other assets, tangible, productive assets. And that gets fixed in the new monetary system. Can be fixed bluntly by just refusing to buy stuff from China, but it can be fixed in other ways as well. And so now the gap between growth and value should begin to work in favor of value. The biggest ever outperformance of growth relative value was from the 30s into the 40s, which was moving from a system of very low inflation to financial repression. And that's the last time that was when you got this massive outperformance of value relative to growth. Now, I hope for very different reasons we're going into financial repression, because obviously the repression of the 1940s was there to fight a world war. So I think that the time has come for more tangible assets, which is why I mentioned Japan coming into this. You said, Charlie, in the real assets, but there are some companies out there with a lot of real assets. And in the very long run, that becomes a problem because they need cash flow to maintain those real assets, but that's a long-term problem. There's a couple of years of re-rating of the value of those assets in this new monetary system, a system without financial repression. Imagine if let's say the only forecast I get right is the following, is that there has to be a massive re-equitization of corporations. Well, just look at all the companies with financial engineering and work out what that means for the price of their equities over the next 10 to 15 years. And re-equitization is one of the clear ways to de-gearing the system. It's not just about inflating away debts. It's stopping certain companies from getting debt and persuading them to have more equity as well. So it's, I can't cover it all in just a few minutes, but I think it's a clear setup for value relative to growth.
High time too.
I'm conscious that there's some fantastic questions coming in from the audience. Can I just throw a couple of those at you? One is, and I'll blend these two together actually, what's the likely trigger that's going to take us from phase 1 to phase 2? And beyond that, what will the next monetary system look like beyond phase 2?
So how long have we got? So I've actually, my third quarter report for clients was exactly lead indicators of the move from phase 1 to phase 2. So how much should I give away? Anyway, keep a very close eye on bank credit growth, in my opinion. I won't go through all the others, but I'm banging on about it. It is really, really important because that is the source of the growth of money. And there is no way that we are going to lower inflation if broad money growth continues at the current pace. Now, it's strongest in America, but very, very recent data in Europe suggests it's picking up strongly in Europe as well. So I would look at that. And that just tells you that we're getting closer. And the more that continues, because the more I talk about it, the more people tell me, well, you're slightly insane, aren't you? Why on earth do you believe these banks will continue to lend money? So people don't believe it. But when they see the evidence of that, then it becomes more and more difficult for them to believe that we can have low inflation with high broad money growth. And that gets us towards phase 2. To be very blunt about it, you might just want to wait until bond yields spike. Now, you have to be very, very quick, very quick. But unless bond yields spike, then the case is still there. Growth up, discount rates down. But if you start seeing something unnatural in bond yields and they look like they're losing control, that is definitely the time when we're moving to phase two. So that's dancing a lot closer to the cliff edge than looking at buying credit growth. But if you want to dance really close to the cliff edge, watch bond yields. If they start going up in an uncontrolled fashion, the equity market will be going down. But that's a time to sell. It could go up 30% before it goes down, but watch those long bond yields. As long as they remain, Greenspan used to have this word, quiescent. As long as they remain quiescent, then the bull market in equities continues. In terms of what the new monetary system looks like, where to begin. Each country moves to finance. Every country that needs financial repression brings it in. That's the entire developed world, I think, without exception. But they don't bring it in at the same time. And that financial repression is the things we've discussed already, but it includes de facto or de jure capital controls, suppression of long-term interest rates, forcing savers into investment products they don't want to own, all of that stuff. But interestingly, not at the same time. So if I think of all the monetary systems that have been set up, I would argue one was set up by the Asian financial crisis, but at least that came to everybody at the same time. The end of Bretton Woods came to everybody at the same time. The creation of Bretton Woods came to everybody at the same time. The gold standard was staggered when it came in. But this one's going to come in on a staggered basis. So you really, going to be massive exchange rate dislocations depending on who goes first. But we end up, for the developed world, in the same place. I think America's probably the last to go. Everyone thinks it's the first to go. But the European Union, I think, is the first to go to severe repression. There's no political force to push back against it. There's no societal force to push back against it. France is one of the most highly geared countries on the planet. So I think Europe first, probably China second. And I've been going about this for a long time, but anybody who wants to sort of do the math for themselves goes to the BIS page on debt service ratios. And the higher your debt service ratio, the more likely you have to go to this new monetary system first. And then as we each do it individually, we've then built a new global monetary system. But the free movement of capital is massively reduced in that new global monetary system. But the countries at the top of the list with the high debt service ratios are not the ones you think they are. So Italy's right at the bottom, lower than Germany, because it really doesn't have an overgeared private sector. The United Kingdom and America are towards the bottom end of the scale. France is right off the top end of the scale. China's at the top end of the scale. So that's the kind of order which it comes in. But if you think of each country builds that financial repression independently, and then after 5 years, you look around and see what the world looks like. It looks pretty much like the world looked like from 1945 to 79, but not all done in a grand hotel in New Hampshire, all done piecemeal over time with massive exchange rate dislocations along the way. And the ability to move capital freely then is at a huge premium because it is so valuable. Because you want to be able to invest for the best opportunities, but you're not allowed to.
Yeah. How do we think about timing all this? I mean, this is the hard bit. I mean, we've already said that there's a possible switch from growth to value in equities that can leave the equity machine running quite happily for investors for a period of time. It might be, gold has failed to respond to pretty obvious signals over the last year or two. How do we think about that? Will central banks start buying gold at some stage? Do you think they have enough self-knowledge to do that? I mean, I see the Indian central bank continues to buy gold, for example. But how confident are you in terms of the timing of the asset reallocation for or is it just a question of just being prepared, just get in position early?
Well, so I kind of refer to the first question, which is what are the lead indicators for phase two, which I've kind of discussed those. And that's really, usually I don't do this sort of thing. I think, usually long-term investor give long-term advice. But this time, I think there is a prospect that the stock market could go 25% higher before any of this happens. I think it's incredibly difficult to work out just how overvalued this thing can get in a world where they insist on doing this. So normally, I would just be saying to everybody now, buy that little bunch of assets that I just mentioned. But perhaps dangerously, one can stay maybe a bit closer to midnight in just global equities. The longer the time horizon one has, one should be moving away from that. how long can this go on for? I mean, it's hard for me to imagine it can go on for more than another 18 months. At the rate at which we're creating money and the rate at which money has been created, how long could the financial system continue to pretend that there is no inflation? I just can't. But I would have said that 6 months ago. So, I'm maybe dancing a little bit close to the door here, but equities. But then you just shrink down to that much narrower pool of assets. And if you're in emerging markets, I believe that the right ones will allow you to remove your capital, and that's important. To be able to, if you're allowed to remove it, you're allowed to put it anywhere or almost anywhere. That's important. People think that capital controls stop you taking money out and putting it in, but they don't stop you putting it in. They welcome with open arms capital coming in. So if you had your capital in a place, I will mention Singapore, which was very keen for you to take it out, then it would be welcome with open arms in the United Kingdom. And there can obviously be a time when you'd want to bring it into the United Kingdom. Equities may be so cheap that you want to bring it in. You might want to take it to America because equities would be so cheap. So maintaining that optionality with capital is a key part of that little basket of assets I mentioned earlier on. And if you're taking a 10-year view, I would do all that today. But the last blow off on this could be spectacular.
So once again, we've got to avoid my favorite expression from the great gold bug, Julian Baring, is to avoid lobster pots, which is countries where you can put the money in, but you can't get it out.
Yeah.
There's a bit of trivia I was going to say because it's New Year tomorrow. And Russell, I want to ask you a question. And now we did a quick chat earlier, so I know you know the answer. But you've got to pretend you don't know the answer. And how much inflation has there been in the 21st century? That's 21 years in America and Britain.
Yeah. So I'll give you the answer that I started with because it was wrong, and then you can tell me what the right answer is. So I went for 100%, and I think that's because I started the clock. When I did it in my mind, I started it with a new monetary system. So the hybrid system, which I would date to 1994, I think is close to 100% in the US. But you tell us the right numbers, Charlie.
Oh, this century in the US, it's 65%, which means a dollar is now worth 60 cents. And in the UK, it's 88% total inflation, which means a pound is now worth 53 pence when you go to the supermarket with your trolley.
Yeah, but I must tell you this great discussion I had at the University of Oxford. I gave a chat on financial, well, just general. And there was a professor of physics who was in the room as I gave this presentation. And I said that the supply of money, inflation was created by money, and it would overwhelm deflation from technology. Now, this gentleman got very upset, and he was wearing a digital watch, and he explained to me that the digital watch, I think, was at $850 or something when it first came out in 1971, 72. Telly Savalas had one, so they had to be very expensive. But now they were about $5 each, and it was complete nonsense for me to say that from 1971, clearly technology had been deflationary. But I think from memory, the over that period, Charlie, the general price level would be up maybe over 800% because we had very high compounding during the 70s. So I think it's a classic example of, because when I make a case for inflation, people say, well, there's technology, and don't forget technology, and never ever forget the power of technology. And yet we've seen technology, we've seen massive technological improvements through my entire lifetime, and the price level is dramatically higher despite that. And take it back to 1900, the idea that we have massively deflationary technological breakthroughs since 1900. And the general price level is much higher. And guess what? It's almost exactly up in line with the supply of money. So obviously Jerome Powell doesn't agree with any of that analysis. So I think it's a very good point. Everybody tells us we've lived through this incredible deflationary technological era. And yet, as you point out, actually, the general price level is up very considerably over that period.
So the point is, we've had this deflationary force, and it's been very real in some areas, perhaps not in things like the cost of education, but that's another story. But the cost of goods have stayed down over the years. So you can only imagine where we'd be, and that's allowed governments to keep monetary policy so easy, and it's allowed for all this kind of excess borrowing and all the rest of it. And so we wouldn't have these high debt GDP ratios in a period of outside of war. Without it, so you only have to ease off some of these big deflationary forces to actually see it go the other way in a spectacular fashion. And I think the one area that I would point to is, if everything we've said, or you're never wrong, Russell, just sometimes early. The only thing that that we haven't discussed that I think could actually also cause a big inflationary shock is the input to everything, which is the cost of energy. And the conversation around energy is extraordinary. We've lost Russell.
Lost Russell.
Yeah. Well, Charlie, so it's New Year tomorrow. And should we talk a little bit about gold and Bitcoin? Well, so hopefully he rejoins us. That could have been his battery that he was complaining about earlier, couldn't it?
It could easily be, yeah.
Fine. Gold and Bitcoin.
That was central bank digital currencies and their role. But actually, that's a great one for you, Charlie. And also, just to get a sense of where we are on your model in terms of cycle, having listened to what Russell's been talking about.
Yeah, I think Russell's brilliant. I mean, it's a real result. We had him on our maiden gold and Bitcoin webinar, so I'm very grateful to him for that. And we've got to remember to tell everyone about his course, his video course, before we finish off.
Yeah.
But the bottom line is that he was talking about financial repression, and that is you've got to have the rate of inflation to be much higher than the interest rate. The interest rate wants to go up at the point at which there's a lack of faith in the government bond market, but they're going to force institutions to buy into those things, and that's going to be very positive for the hard assets, particularly gold, and we'll mention Bitcoin in a second. But the thing about gold is it's priced off, in my opinion, long-term real interest rates, not short-term. And people were very confused in 2020 why gold went up so much into the summer of 2020. And then it just slumped ever since. And so people say, there's all this inflation over the last 18 months, why didn't gold go up? And my answer is that the gold saw it all coming. It went up a lot from 2018 to 2020, from $1,200 to $2,000. That's a hell of a move for a piece of metal, particularly a monetary metal. And it handed the baton on to Bitcoin, which is a risk-on asset. So the environment for risky assets has been much stronger in the last 18 months, which we at ByteTree firmly believe Bitcoin's a risky asset and gold's a safe haven, although both are inflation sensitive. And so, that's the blend. Now, Russell's back, which is, thank God for that, is all I can say.
Well, greetings again from the merry Firth. I think the wind must be in the wrong direction at the minute. So let's hope the wind stays in the right direction. So anyway, I don't know how long, I mean, my point, I think you got the last point, which was over the long term, technology is not deflationary if money supply growth is quite high. That was kind of the point. And that's why your statistic, Jordy, is very good. Everyone thinks we've lived through this period of gross deflation caused by technology, but even that, Alan Greenspan managed to inflate that away. So
I don't know whether we touch on, we have gone on quite long, but just one more subject, which I think is sort of of practical interest to everyone, and I'm fascinated by, is residential house prices. One would think it would fall into the basket of stores of wealth alongside gold, etc. But yet it's a very financialized asset these days in a way that I don't think it has been in the past. I mean, we're all up to the yin-yangs in mortgage debt. Does that change the outlook for that?
I'm still very optimistic on it. But if we go back to the 70s when it worked spectacularly, it didn't actually work spectacularly in terms of the nominal return. So the nominal return was not much ahead of inflation. But the total return was spectacular because nearly everybody had borrowed against it. And today, all of us have this incredibly, well, if you're British, that is, you've got this incredibly new opportunity. It's an old opportunity for Americans. It's an opportunity. I don't know how long the Danes have had it, but they seem to have had it for quite a long time. And it's an opportunity to borrow fixed for a very long period of time. So I'm sure you know that the pension funds are so desperate, back to our financial repression argument, for long-term income, that they're now offering fixed mortgages. I think I saw one at 40 years the other day. And that's why residential property is attractive. If the residential property was to go up in line with inflation, and I've every reason to think that it would do, and you were borrowing fixed for 40 years, or even 20 years, or even 10 years, then that is where the value comes from residential property. And the thing is, you can't do that with other things. Go to a pension fund and try and borrow for 40 years over an equity portfolio, and you might struggle. So that residential property gives you the right and the ability to put that leverage into a portfolio. And if debts are being inflated away, you benefit from that. So as you point out, it was a much less financialized asset class in the early 1970s. But even so, it still has that unique attribute. And and the difference in the 1970s, if you're British, is you can now get fixed, which you couldn't get in the 70s. You could if you're American, but now it's come to the United Kingdom. And I think it's something that everybody should be looking into. I've not seen the rates, but a friend of mine told me he'd been offered a 10-year sterling mortgage at 150 basis points.
Wow, I'm in.
Yeah. So it may be the debt bit that brings the attractiveness to the residential real estate bit.
Now, Russell, I've known you for several years, but my favourite 2 days I spent with you was on the history of financial markets, economic history of financial markets course that you've been giving for how long now? Can you tell us about that?
Yeah, so we launched that in 2004. I'm glad you said that was your favourite 2 days, because that means it was even better than the evenings we spent in the pub together. So that's quite an endorsement.
Informative. It was a very good course. And tell us about the course, why you set it up, and all that. So
the reason we're talking about now is it's still running. It runs in real time. It runs in March and October in London, but we've also created a video version of that. There's nearly 18 hours of video, self-test questions, additional reading materials. You can do it entirely online now. It used to be called A Practical History of Financial Markets, but we are doing it in conjunction with Heriot-Watt University. And they thought Advanced Valuation in Financial Markets was a much better title. So just to warn anybody who's already taken the Practical History of Financial Markets, this is the same course. You might want to take it twice. I know some people have taken it 3 times, actually. Some of them very senior in our industry have taken it 3 times. So we look at the history of valuations going back as far as 1800, so you get a long-term perspective on valuation for equities and which measures of value have worked and which haven't. Now, they only work over long-term holding periods. That's the problem with valuations. Otherwise, life would be easy and investment would be easy. And then we look at the forces that drive mean reversion around these measures of value. And the ones we select as the most important, doesn't mean to say they're all of them, are changing inflationary expectations, the rather amorphous concept of liquidity. We call it money, credit, and asset prices, and psychology as well. And then we have lectures for that. And you probably know some of them. John Greenwood actually runs our course on liquidity theory of asset prices. Peter Warburton does changing inflationary expectations. Herman Brodie on psychology. And Derry Pickford teaches this long-term course on value, very much based on the work of Andrew Smithers, who many of you will also know. So that's the course. And we've educated over 1,500 professional fund managers. So, some people, there's one guy's flown across the Atlantic from Brazil twice to take it. So have a look at the website, didascoeducation.org. You'll see plenty about the course. And, we all need a New Year's resolution. And taking the Advanced Valuation in Financial Markets course should, of course, be everybody's New Year's resolution.
Well, I commend that course. It's fantastic. And Herman Brodie is absolutely brilliant. Really gets you thinking about all the human mistakes and why our brains are miswired to be in the investment business at all. That's one of the reasons I like factual models. It's just trying to sort of slap you in the face.
What I say about our course is I very arrogantly think it will get you to ask most of the right questions. Whether we have any of the right answers is a different point. But the point is, unless you ask the right questions, what's the point? So that's my, I'm obviously a bit of a missionary for financial history. Financial history doesn't have the answers, but it might help you ask the right questions. And that is at least half the business, if not more than half the business. And, going back to that Asian financial crisis, Charlie, I kind of arrived and maybe by pure luck asked the right questions, but they were not questions that were being widely asked. It wasn't that I had particularly good answers. But I was just asking these questions that other people weren't. And it was just even knowing a little bit of financial history, particularly the petrodollar boom, was just wondering, how this could be, how could it repeat, but this time be successful? So come on the course, learn some of the right questions, and hopefully one day you'll be lucky enough also to. And anyway, the beauty of our business is you don't need the right answers. You just need better answers than the consensus.
I've posted a link in the chat room so everyone can click on that and go and have a look. But it's what a fantastic lineup that is. I kind of feel dreadful. There's some terrific questions that have come in from everyone, and I just don't think we've got enough time to really deal with them. We haven't even touched on CBDCs or where China goes from here, or there's various others. But
well, I can finish just by putting in a plug for my research, russellnapier.co.uk, so that you can actually buy the research as.
There we go. So find your answers there.
Yeah.
Money well spent.
Yeah, and Russell, we'll book you, if you don't mind, 30th December 2023, or 2022 even. I can't even do my days. That's how.
So I'm gonna do well. Yeah. So that's okay. We'll try that. I'll be in the same position, crouching on the edge of the Murray Firth, and if the sea level hasn't risen, Charlie, we'll get together this time next year.
Brilliant. Well, should we say thank you very much and Happy New Year?
Yeah. Thank you so much. Thank you.
Happy New Year to everybody.
Absolutely brilliant. Thank you so much, Russell. Thank you for coming along. All the best.
Okay.